Well, it is such an honor to be here, and I think that the white coat investor as an idea is going to be one of the most groundbreaking efforts that we will look back in history of people taking back financial control, people not getting taken advantage of with their finances. So we can think of, Jack Bogle and Warren Buffett and the white coat investor. So you heard it here first, folks. I am from Little Rock, Arkansas. I don't know if anybody knows where that is. Okay, fantastic. So most of the clients I've worked with, and we've worked with a lot of folks through the white coat investor, we do over video conferencing. So it's a huge honor to be able to spot a couple friendly faces that we've worked with in the past here in the audience. So it's a lot of fun. Today's topic is very daunting, first of all. It is a very daunting prospect to talk to you all, because I know that everyone here has done a fair amount to a lot of reading and self-research. So trying to figure out a talk that will reach everyone from, hey, I'm kind of just getting interested in this, to, hey, you've probably read more books than me on this, is tough. But I think that I've got a talk that will answer what everybody is hopefully looking for in this conference. So what I'm going to specifically discuss is some of the issues that docs face early in their careers, but I'm not going to delve into those issues, because you can go and read about how much house to buy, right? You can go read about how to refinance your student loans. You can do all of those things. What I find when I work with folks that are DIYing their own financial plan is they have a lot of deep information on some very narrow topics, and what they're really looking for is, how do you weave it all together? The objective today is, how do you weave all these things swimming around in your head together into a comprehensive plan? And then I am going to talk about engaging with a financial advisor. I am proud of the fact that I kind of came up with this idea for this business, and that I do believe it is sustainable. So while I have insider knowledge about how people make money in this industry and how that affects the advice that you get, I have an outsider's perspective. I really do believe that I am looking it through your eyes. So let's start, because I do believe you should know, anybody you're getting advice from, you should know where that advice is coming from. And so I want to give you the history, a little bit more of how this company started and what role that I'm playing right now in people DIYing their finances. So my story starts back in 2007. Like all of my fellow idealistic Harvard grads, I went out into the world and joined an investment bank. And I went into the world of stock picking. And so a lot of people might know in this room, if you've read about it, it was particularly in the sell-side stock analysis. And I worked for a superstar stock picker, Tim Quillen, and he's a CFA, constantly in, Best of Wall Street, and we were having a lot of fun because we were right a whole bunch. But that was also 2007. So in 2008, we know what happened. A couple banks failed. Things still looked pretty rosy, but by the spring of 2009, the investment banks had to make sure that those windows were bolted on pretty tightly. And so while everyone else was asking the question of, where is the stock market going to go, and how low can it go, and what's the rebound, what's the market timing, I had one nagging question. How did all of these people buy houses they couldn't afford? It wasn't like these were high-end investors that were causing this big asset bubble. No, they were normal people. Have y'all watched The Big Short or read it? I mean, you've seen the people that were buying the houses. So how did all those people get such bad advice? Well, interesting, I couldn't get the question out of my head. And I was at the time buying a house myself. And my dear friend was my real estate agent. And one night I called her up and I said, how do you get paid? And she goes, oh, you don't have to worry about that. I get paid out of the transaction. And I said, well, so tell me more. How do you get paid? And she goes, I get a percentage of how much you buy of the house. And she said, don't worry. The seller pays it. It's not your problem. And I said, Well, if the seller's paying it, then does that mean you work for the seller? And I realized these were really stupid questions. But that night, I had this realization that when you buy a house, the seller's agent and the buyer's agent and the mortgage lender are all working for the seller, because their financial incentives are for you to buy as much house as possible and as quickly as possible. And all three of them have that same financial incentive. So then I started thinking, well, gosh, okay, so that's not where you want to get advice. So where's the next place? Well, you look at, all the commercials. There's abundant commercials on insurance agents. And insurance agents are so kind, they'll actually help you with all of your financial planning needs, right? So they're going to help you with your kids' college. I mean, you see weddings, you see all these flashes of your life going before you. But how do they make money? You got to buy a policy, right? So if you walk in and you ask, should I pay off this student loan aggressively, you will probably walk out of the office with a very robust whole life policy and a little unclear about what you should do with your student loans. So we know, don't go to someone who sells insurance to give advice, right? I think most people in this room would probably agree with that statement. Okay, the next one, which is a great improvement. The industry is constantly improving how people get advice. So the next one is a fee-only advisor. And I don't like to use a lot of jargon, so let me just explain what that is. That is someone who takes a percentage, you give them money, and then they take a percentage of that money every year in a fee. And so the improvement on that is they're not necessarily selling you something. But do you know what rate of return you would have to get fixed in the market to have a tax equivalent yield of a 6.8% student loan? 7.8%, assuming you're in the 15% capital gains bracket. It'd be higher if you're in the 20 or higher. Who could guarantee you a rate of return right now of 7.8%? Now, if you have an advisor that can only make money if you give your incremental dollar to them, are you going to get a good, or are you certain that you will get an unbiased assessment on whether you should invest your incremental dollar with them or pay off student loan debt? I would argue no, you cannot be certain. There are a lot of wonderful fee-only financial advisors. I'm friends with many of them, and many of them make very good decisions for their clients on student loan debt. But it's important to understand their financial interest is counter to yours if you have any situation like that. Here's the other issue with a fee-only advisor. Let's say you're a surgeon, and you do a surgery, and it costs $10,000. And the next year, your patient comes in for a 1-hour checkup, and you send them a bill for $10,200. Does that make sense? That is how the financial advising world works with fee-only advisors. You hand an advisor $1 million to invest. I'm giving y'all insider information here. They make 1% on that, which is $10,000. Now, let's say you didn't add to it. That was like a nest egg that you inherited. And we just had the market return that we had of 20%. So now you have $1.2 million. They make $10,200 from you the second year for probably a 1-hour check-in and maybe another hour of work rebalancing. Does that make sense? It really doesn't make sense. So here is what I did. I said, what if I created a company? So remember, I was gainfully employed at the time, doing pretty well. I said, what if I just left and started a company where I invented a financial planning relationship from the ground up? What would that look like? And this is what it came to. It's got to be hourly so that you can align your financial interests with your client. It needs to be fixed so that you don't take advantage of an hourly rate that you can just continue to charge and charge and charge and bill your client. And here's the next kicker. you really shouldn't annuitize your client. I really believe that. Now, that makes it a tough business. So when I left the investment bank after 4 years, hung a shingle out, this was 7 years ago, my fee was actually $45 an hour. I should have worked with a business coach. So $45 an hour. I had run all these numbers and figured out how it would work. They were all wrong. And so anyway, I started experimenting with how can I make this a sustainable business that also works in the best interest of my clients. And here we are today. The fee is now $200 an hour. We have a fixed financial planning fee that's one time. We are happy for our clients to come to us one time. We do 20 hours of work. We have a prescribed financial planning process. It's $4,000. That is enough money for us, and that is an affordable fee for most people that they can do one time, and then they never have to come back again. Now, our clients do tend to come back. They come back year after year for check-ins. We had kind of told people to expect it to be probably around 4 hours of work or $800 to $900. We have been finding it's much less than that. I just did an annual 2 weeks ago that took 30 minutes, and we sent a bill for $100. This is how we run our business. I am very proud of it. Okay. But the question is $4,000 too much money for you? And it might be. I've met a lot of you, and you don't need to pay $4,000 for a plan. You could probably be a better planner than most planners out there. So let me help you figure out now where you might fit in the industry. So let's start with the total do-it-yourself. Like, you are going to take this on. You are going to read every book out there. You're going to read the blogs, and you can do it on your own. And there are so many people in here that I authentically think ought to do this. This is how you know that this is where that you are that person. You work a 12-hour shift, and you come home, and you can't wait to open up the Intelligent Investor. If that is you, then that is for you. I give a great parallel. So my husband is a chemical engineer, but really wishes he was a mechanical engineer, and he loves it when stuff breaks in our house. So 3 days after our third child was born, our stove broke, and I called up, a repairman to come fix it, and he said, "Oh man, that's going to be $60." Or wait, what was it? It's going to be $600 because they had to replace all 4 switches in my stove. It probably wasn't worth $600 plus his labor. So I made the mistake of telling my husband this, and he figured out he could buy those 4 switches for $150. And 2 days later, an Amazon package showed up on our front porch, and this is what our stove looked like. And I've never had a happier husband. If this is you, you need to DIY your finances. It's fun. You can do it. You just have to make sure you're saving enough money. Who cares if you do a little bit wrong this way or the other? If you're saving enough money, you can absolutely do it, and you can sleep well at night doing it. The next step up from that is, let's say you're very comfortable doing it, but you feel like you need just a little bit of support on the investment side. Investing is very easy and very simple, but I think it still makes people nervous, and there's not a problem with that. There are a lot of robo-advisors out there that you can use. Like, even Vanguard has a flagship service that you can pay, I don't know what the latest is, maybe 25 basis points. Again, we try not to use jargon. That's 0.25% of the money you give Vanguard. Depending on what that level is, they'll give you a flagship service. Betterment has something like that. I know folks that have used Wealthfront. That could be a really good marriage. I'll do the reading. I'll make sure I'm doing enough homework for how much to save and how to explore all tax efficiencies, and we're going to get to that in a second. And then I'll kind of let someone else provide a little adult supervision for my investing. Okay, the next line up is to take the White Coat Investor DIY course. And this is not a plug just because I've been invited to speak here. Authentically, that's where I would go next because it is objective. You're not coming from a financial planner who has a financial conflict of interest in there, right? So he has a very objective view of the industry and a very deep, good view of the industry. And so I would argue that should be your next choice. Okay, so let's say, man, I don't have time to do a whole course. I really want to focus my time on being a doctor. The next step would be to hire an hourly financial advisor. Now you have two options. So like for instance, I just mentioned we have a full financial plan for $4,000. I think some other advisors are starting to pop up around the country, and we're willing to let you hire us by the hour just to look over things. So that's another option. But here's the thing, it's still your responsibility because you're not handing that person your money. You're still ultimately responsible for rebalancing your investments. You're ultimately responsible for your money. You're just hiring for objective advice. And then the final place that I would go, and this is the, you know what, and there is no judgment on any of these. This is the, I really just don't want to do this at all. It scares me. A lot of people really worry about their finances. In this case, you hand your money to someone, but make sure they charge a fixed fee. I saw there's a company out there, they charge a fixed fee. That's what you want to look for. Now, you're going to pay every year, but you're paying a lot of money for objectivity. And to have bad advice can end up costing people hundreds of thousands of dollars over time. So I would argue, invest in a way that you're going to get that objective advice, and a fixed fee will achieve that. A percentage of assets, you have to worry about that financial conflict. Any questions on the spectrum of how to DIY your finances or advisory relationships? Yes. Yes, I'm so glad you said that. I really do believe in a jargon-free zone. When I say basis points, that's just a way about talking about small percentages. So for instance, you have 1 percentage point. If you have 0.8 percentage point, oftentimes that's difficult to say. So people in the industry will say 80 basis points. It's good to know this jargon. If you're going to DIY it, you kind of want to know how people talk. So a lot of target retirement funds are reflected in basis points. So people might say that target date retirement fund will cost 14 basis points, which is 0.14% of your money every year. Yes?
Could you explain fiduciary responsibility?
Yes. So there is a thing called fiduciary responsibility, but I would never rely on it because I don't think it's strong enough. So what a fiduciary says, and it's highly controversial, it's been knocked down. The federal government has tried to require all advisors to be fiduciaries. It's highly controversial. And it means you have to act in the best interest of your client, not your own best interest. That's the fiduciary rule. It has gone nowhere. And I say thank God, because the fiduciary rule has so many ways that you can fine print out of these sticky situations where you do have conflicts, that what it would do is expand the umbrella of who gets to call themselves a fiduciary, and it simply dilutes that as a concept. I believe that if you want a fiduciary, you have to do your own homework to make sure someone is acting in your own best interest. Good question.